Hello, welcome back to your Econ lectures. This week and the next couple of weeks, we're going to be really digging into the supply side of the market. We're going to be starting this week with productions and costs, looking at how firms make profit maximizing decisions, how they choose which quantity to produce. We'll talk about shutdown conditions in the short run and long run, economic profit. And then we're going to get into different types of market structures in the next few weeks, starting with perfect competition and going all the way up to monopolies. And we'll look at how demand functions, marginal revenue, profit, all those things are calculated differently depending on the type of market structure. So this week, we're going to start with discussing what is a production function. We'll look at marginal and average production. Then we're going to develop some cost curves based on total, marginal, average, variable, and fixed costs. I'm going to show you how these turn into the company's individual supply curves. We'll look at how that makes the market supply curve. We'll talk about shutdown conditions, economies of scale, what production looks like in the short run versus the long run. And then we'll also talk about. So, first, let's talk a little bit about the production function. So, this is really looking at how the factors of production work together to create an output or a quantity. So, this could be natural resources, capital, technology, labor, entrepreneurship, anything that's part of that input process in production. And we can have fixed inputs, which means we can't change the amount we have, or variable inputs means you can increase or decrease with that quantity produced. So, a fixed input is really something that can't be changed in a short period of time. So you may have a store, a certain type of store, and you have 100 square feet, you have a counter space, you have some fixed amount of space. And in the short run, you can't just say, well, weekends are busier, so we need twice as much space. And during the week is less busy, so we're just going to use, a smaller amount of space. If you want to increase the size of your store, that's going to be more of a long-term decision. You have to wait for some other larger building, maybe even to be open. And so we're just going to see that there are things that can't be changed quickly. Typically, when we talk about fixed inputs, we're really looking at capital. So technology, machinery, factories, buildings, some of these very large physical resources that can produce a lot of stuff or a very central part of the production process. Variable inputs, on the other hand, can be easily increased or decreased in a short period of time. So if you need to produce a little bit more, you can have employees can stay and work overtime. They can work some extra hours. You can maybe hire a temporary worker. You can have people work fewer hours. There's just ways to increase or decrease it to meet that changing production quantity just on a day to day basis. And economists often use a shorthand for the production function where quantity is a function of labor and capital. So K means capital. Because C, we already use it for a whole bunch of other stuff in economics. So we're going to just use K for capital. So why are there only two inputs here? Why is it just labor and capital? If you want, you can go check out your book. It will go into a longer production function earlier on that includes all of those other inputs of production. But for at least our more simple models, we really are just looking at labor and capital. Those are going to be our main two components, the things that we're going to increase or decrease and try to optimize production with. So you definitely can get more complicated with this. You can add all those factors of production, but for right now, we're just going to focus on labor and capital. So in the short run, this is the period of time where some factors of production are fixed. It could be for a few months, it could be a year or 3 years. The actual amount of time the short run is really just depends. But for this, we're going to say that in the short run, capital is fixed. So the only thing that we can change between today and tomorrow is how many people we have working. So labor is going to be variable and capital is going to be fixed. And so this graph, this is from your book, it shows how total production changes as the number of hours worked changes per day, or possibly the number of workers changes. So it says units of labor per day. Economics tries to be very general, really generic. It'll say units of work, widgets, which is not, it's just nonsense, but it has to do with it's a nonsense product. And so here it could be like number of hours, it could be number of people per day. Your book might say workers per day. I'm just going to say hours of work on this slide, but it really doesn't matter, right? It's just the number of units. And we'll get into this a little bit later in another chapter where we're talking more about like how many people to hire, how wages are determined. The marginal product of labor is going to be the extra quantity produced by one more worker or one more hour of work. The average product of labor is going to be used to compare overall productivity, especially when we're comparing like the same company over time or we're comparing between companies or between countries. And what we can see from this graph, okay, is that this is actually showing us total production. Total production. From here, we can actually get marginal production. We can get average production. And here, in our definition over here, we say marginal product of labor. Marginal, remember, just means extra. Product is like the quantity, how much stuff we made. And then of labor is like per worker or per hour worked. Okay, so marginal product is if we add one more worker, one more hour, how much extra stuff are we going to get? And then average product of labor is you take the total divided by the number of people or the number of hours and see like how much are we making per person or per hour. And both of these are very useful in economics, but they have different purposes. So whenever you see marginal, we're always going to use marginal to find some kind of best output, best combination, best something. So the marginal helps us find our optimal choice. But average, we can use this for calculating profit, for determining maybe if we want to shut down, increase production. So we'll get into more of what we use that for a little bit later. But marginal is going to be what we're doing for our optimal choice. And when you see on this chart here, every time we add one more hour of worker, we move to a new spot on this graph. And sometimes we get increasing marginal productivity, meaning adding one more worker, one more extra hour is going to make us more productive than the previous hour. At some point, we get decreasing marginal returns or decreasing marginal product of labor. And then at some point, it can even go negative. And so let's look at that on the next slide. Here it's highlighted for you in slightly different shades of purple. So this is in your book. And this lighter shade of purple right here, this is the area where we have increasing marginal returns. So the idea there is that we're going to be adding more stuff per worker or per hour worked. It's going to become basically more productive. So when we go, like the first worker or first hour of work makes one jacket. When we get to point C, that second person brings our total up to 3. So they're making 2 extra jackets. Right? Basically twice as productive as that first one. When we go from C to D, so adding one more worker, looks like we get up to 7. So adding that third person or third hour is going to make 4 extra jackets. And then it starts to drop. So this is increasing marginal returns. Decreasing marginal returns is going to be in this next section here. So from D to E, we add one more person and we're going to go from 7 to 9. So now it's diminishing, decreasing. So the last one added 4. This one's only adding 2. And then it looks like the next one's only going to add 1 more. The next one's only going to add like slightly less than 1 more. The last one, maybe just like, a tenth of a jacket. And then once you go from H to I, we actually get negative returns, meaning if we add one more person, we're actually going to make less jackets than if we didn't hire that person or we didn't have that hour of work. So marginal returns is the typical production function, starts with increasing, shifts to decreasing, finally reaches a point of negative returns. And let's look at some reasons why that might happen. So for example, here we have a picture of a coffee shop counter. There, it looks like there's one register, there's 2 coffee machines, a little bit of counter space, some spot for pastries. So think about how many people can fit behind this counter. In the short run, we would say that the counter space, the number of coffee machines, the actual display case, we would say that this is fixed in the short run. They have some very specific amount and they can't just increase their counter size because they're busy in the morning. They're sort of stuck with whatever they have. Labor, however, the number of employees or even just the hours that they're working is going to be variable. So we can hire 3 people in the morning, 1 person in the afternoon. We can change how many people are going to be back there. And if we want to apply this to like the increasing, diminishing, and negative marginal returns, think of it this way. So let's say we have 1 person behind our counter. Here, I'll draw a counter. Here's our counter. We have 1 person behind our counter, and they are going to take the order. So here's our cash register. Okay, they're going to take the order. Then after they do that, they're going to have to go make your coffee, serve it to the customer, and then go back, take another order, or maybe they'll take 2 orders at a time. But it's going to be not super efficient. They're going to have to change their gloves a lot because you can't touch money and then touch food. They're going to be walking around a lot, so they're going to have to be moving. Particularly, I mean, this isn't a very particularly large coffee shop, but they have to move all the way across the whole counter to do each of these tasks. And so let's say this one worker, so we'll say number of baristas is 1, and number of drinks that they can make per hour is 5. So then when we add a second person working at our coffee shop, it's actually going to increase productivity. When we add that second person, now our workers can specialize in different tasks. Somebody can be taking the cash and handing over the orders. Another person can be making the drinks, and they can be focusing and specializing and being, really efficient. So maybe when we add that second person, they can make 10 extra drinks. So we're going to put marginal productivity of labor, MPL. Okay. I'm going to write MPL. So this is the extra per worker, not the total. So when we add that second person, they can make 10 drinks per hour, which brings our total quantity of drinks. Our first one is 5. Now we're up to 15. So we've got this increasing productivity. Now let's say we add the third person. Maybe we're going to get into diminishing marginal returns. So maybe that third person adds only 6 more coffees. Brings our total to 21. If we add a fourth person, I should have drawn this better. Let's say fourth person maybe only does like 3 more, just 24. Fifth person, on and on. And then at some point you get negative, right? So what happens if we have like 10 people back here? Are they going to be very productive? No, probably not, right? You're going to maybe have so many people behind that counter that people can't make any drinks. So the first 2 people who were very productive when they were by themselves can't make anything because they're just squished, elbow to elbow. You can't reach anything. You're pushing people around and you get like this negative productivity. So maybe it goes down and they can make like 1 coffee per hour if they have 10 people back there. So I think examples like this where you have like a small shop, you're very limited on that physical space to take orders and make stuff, makes it a little bit easier to understand this increasing, diminishing, and negative marginal returns. But this happens in all companies, so not just small ones. They're limited in their physical space. They have a limited number of computers or machinery or whatever it is. And so while they can try to increase labor to a certain point, at some point they're going to have enough people, and the only way to expand operations would be to increase the amount of capital. So if we wanted to have 10 coffee baristas, we need to have a much bigger coffee shop. So we're going to assume that this graph is showing us fixed capital in the short run, and the only thing that we're changing is labor. So in our example of a coffee shop, maybe our second worker, we're still getting increasing marginal returns. The fourth worker, we're getting decreasing. They're still able to add the number of coffees we make. We're still being more productive with that fourth worker, but it's just not as much as that, initial bump from getting the second worker. And then maybe with the 10th worker, we're getting negative marginal returns because there's just too many people back there. Now we want to turn into cost of production. So if you look at this other graph, these last couple ones we've been looking at, this is just looking at total production. It's not at all looking at how much it's costing to make this. It's just saying if we have one person working here, we can make one. If we have 10 people working here, we can make 20. It's just looking at the total output compared to the total inputs of labor. And we want to take that a little bit further now, and we want to say, well, how much is it going to cost? Because sure, maybe if I add that fourth worker, they can make, I don't remember what I said. Let's say the fourth worker makes 3 more coffees per hour. So 3 more coffees per hour. It's increasing total production, but how much is it going to cost me? Is it going to be worth it for the business owner to hire that fourth person? So we care also about the cost of production. So total cost, variable costs, fixed costs, input costs, all the different costs. Okay, so we're going to look at some of those. So when we're talking about total cost of production, we're going to look at fixed costs and variable costs. And in these examples, we started off a little bit simple. We're just going to say capital and variable cost is labor. But variable costs can also include materials, natural resources. So if we're talking about coffee, I need coffee beans, I need milk. I'm going to be using electricity to heat the coffee, right? So all the things that are going to cost more money if I make one more cup of coffee, all of those things count in the variable costs. The fixed costs are going to be things that have nothing to do with my output. So I had to buy a coffee machine. I have to pay, if I'm the owner, I have to pay rent on the building. I have to buy a cash register. Maybe I have to buy software for processing orders through the app. All the things that just there's a fixed cost and it doesn't have anything to do with my total output. So total cost, we're going to represent it here with TC. Fixed costs will be FC, and then variable costs will be VC. So total cost is equal to fixed plus variable. All right, what about opportunity cost? I know you're all thinking this right now. We already talked about opportunity cost. You know it's a thing in economics. We care about this. How are we going to make sure we're including opportunity cost? Don't worry, we've got you covered. We are going to count it as a fixed cost. So it has nothing to do with the output quantity. It's just going to be like a flat rate. And later on, this week and next week, we're going to get a little bit more into how do we actually calculate opportunity costs and include it in our equations. Sometimes you're going to see it as something we calculate and think about, but if we don't see it directly in our example, we're just going to assume that it's part of that fixed cost. Firms are going to use their average and marginal costs to determine optimal levels of production, when to enter a market, and when to shut down. So marginal, we're going to use this for optimal. How do we pick that best quantity to produce? How do we maximize our profit? And then average, we're going to use that for calculating profit and looking at when we should enter and exit a market. So here's some equations for you. We will get into these a little bit more later. But when we're looking at average cost, it's going to be some kind of total divided by the quantity. So average total cost is going to be all of our costs divided by quantity. Average variable cost will be just the variable costs divided by quantity. Average fixed costs is going to be just the fixed costs divided by quantity. And then our marginal cost function, this is not an average, right? This is an extra. So extra total cost divided by extra total quantity. So if we're just going up one more unit, it's just that difference between the totals, like we've already done in some of our previous chapters for marginal analysis. And this is going to be important for maximizing profit because costs are not constant. So if you're looking at like the average total cost, it's giving you that same amount for every unit, which isn't really accurate. We actually potentially have increasing total costs or increasing average costs, increasing variable costs, maybe decreasing fixed costs. And so marginal tells you how much it's going to cost to produce one more unit. And if you're wanting to maximize profit, you want to make sure that that last unit you produced does not cost, or you're going to be able to sell it for at least, as much as it's costing you to produce. Average variable, average fixed cost, these are helpful when we're calculating profit. We're determining entry and exit into the market because market prices tend to be constant, they tend to be fixed. If you go to the store, you're buying milk, every single, jug of milk is $4. but it didn't cost $4 to produce each one. Maybe some of them cost $1, some of them cost $7, right? Uh, Really, they could have potentially much different costs. And depending on what those costs of production are, at least in the long run, our firms are going to want to stay in business if prices are covering their marginal costs, they're covering their average costs, they're not losing money. So let's get into all of those details in the next couple slides and in our next couple weeks. I'm not going to go through all of this right here. You don't need to hear me read it out, but this is just listing the actual definitions of what those costs are. So if you want to read this out, you're a word person, you want to look at it more, um, this is a really good slide. Maybe print this out, make a little note card, and it can help you remember what all of these are. All right, so now we're going to make cost curves. So cost curves are going to be used by individual firms to determine that optimal output, to determine profit, to determine when they should enter and exit the market. So this is a graph from your book, and up here at the top, it is listing a table that's got all of the different things listed. So total cost, it's broken out by average and variable costs. So for instance, total cost is $300, 200 of that is fixed, and 100 of that is variable. When we get to the second quantity, our total cost is 363. And notice fixed costs went down. Wait, I thought fixed costs stayed the same. They do. So total fixed cost stays the same. But here, this is showing you average fixed cost. So if our total fixed cost is $200, when we are only making one, that means all of that goes into that first unit. But now when we're making two, we can split it in half. So 100 of that fixed cost goes to the first unit, 100 to the second one. And you can see that all the way out, right? So we've got 4. Now that's $200 divided by 4. We've got 10, that's $200 divided by 10. Now you only get $20 per unit. And this can be really helpful, especially if you're trying to make a decision to be in business or not. If you have a really, really high fixed cost, you're going to need to have a lot of quantity to sort of cover that. Or you're going to need a really high price to cover that. And then variable costs, they can increase, decrease, stay the same, go up or down. We're actually going to see a pattern where first we see them decreasing. So we're going to see decreasing average variable cost, but at some point it's going to start going back up, and then we're going to see increasing. And so we can see that here, this second yellow line here, it's going down. We hit some low point, and then it starts going up again. On this graph down here, also we have this green line. This is our average fixed cost, and you can see that it just goes down. So the more quantity you have, the smaller that is. We're actually going to take this off of the rest of our graphs. We're not going to look at average fixed cost. It just makes it a little bit busier, and we don't need that as a separate number because it's already calculated. It's already included in this average total cost curve. We do want to break out variable costs because then it helps us make some short run decisions that are different from long run. But otherwise we don't need that. And then marginal, so you can see how they calculated marginal cost up here. Okay, and then marginal cost, which is this bottom row down here, this is going to tell you that extra between the totals. So when we went from, so 0 starts at 200 because that fixed cost has nothing to do with quantity. So fixed cost is 200. And then to create one more, now we have $100 extra. To get to quantity of 2, it's going to go up another $63. And then to get that third quantity, we go from 363 to 400. So that's another 37, 33, 25, and so on. So this is going to be the extra between total cost. Okay, so it's not looking at the extra average cost. Average cost actually might be going down. But you'll notice this also hits a low point and starts going up too. Okay. And that's because it's linked to that total cost function. And when we see average total cost increasing, we're going to see marginal costs are increasing as well. Okay, so let's look at how marginal cost is actually related to our supply curve. So most of your cost curve graphs are going to look more like this. They're just going to have 3 curves, so they're not going to have all 4. We're going to have marginal cost, average total cost, and average variable cost. And we're going to have these three because we need them to make decisions. So marginal cost, we're going to use for optimal quantity. Average total cost, we're going to use this for calculating profit and also for our long run shutdown decision. And average variable cost, we are going to use this for our short run shutdown condition. So each of these has its own function, its own thing that we're going to use it for. Fixed cost, we don't need it separate because it's already part of average total cost. Interestingly, though, okay, so since marginal cost is used to determine the level of output or the level of quantity, it actually turns into our supply curve. So marginal cost is going to become the supply curve. It's that upward sloping portion. So here where it hits this like lowest point, it's going to start going up. This whole upward sloping part of the marginal cost is going to be our supply curve. The individual supply curve. And market supply curve is all of the individual firms put together. So it's only the upward sloping portion. And then firms are going to make their decision based on marginal cost is equal to or less than marginal revenue. So we'll get into some examples of that. It's going to look a little bit different for perfectly competitive markets versus monopoly because marginal revenue is going to either be decreasing, increasing, constant, like it'll look a little bit different. But we're going to still use this marginal rule. So just like we did for utility or any of our marginal cost benefit analysis, we're using that to find that best combination. And remember, the goal is profit maximization. We're trying to get the most possible profit. We're trying to minimize those losses. And using the marginal rule helps us find that point. So we use marginal cost to find the optimum, and then we can calculate profit and other things from there. And we're going to see that some companies, having a larger company is going to make it cheaper to produce stuff. And other types of companies, having a smaller company might actually make it cheaper to produce stuff. And so when you're thinking about this, it's actually called economies of scale. And this is looking at returns to scale. So how the amount of inputs going into your manufacturing process turns into some amount of quantity. So we would say constant returns to scale means if you double your inputs, you're going to double your outputs. So if I have 2 employees and I'm making 10 coffees per hour, when I go to 4 employees, then I'm going to be making 20 coffees per hour. So double the amount of labor, double everything, you get double output, double quantity. Decreasing returns to scale, which is actually probably the most common for most businesses, is where doubling your inputs leads to less than doubling your outputs. So if I have 2 workers and 10 coffees, and then I go to 4 workers, I'm only going to have 18 coffees, right? It's not doubling. There's a lot of reasons for that. We're not going to be able to get into most of them here. Take a business class if you're interested in this. But even if just things like in California, small businesses have different minimum wage rules or different tax laws, different internal administrative requirements than some larger businesses. So they may have, smaller costs there. But even as companies grow, you have more overhead, you have more costs. It just gets more expensive to produce stuff. And so if you want to grow the size of your company, it's probably going to cost more. And then increasing returns to scale, which sometimes people, when they say economies of scale, they're only actually talking about increasing, even though it could refer to all of these. This is where everyone wants to be, where you double your inputs and it more than doubles your outputs. So you grow your company, you get larger, and it means you're producing things cheaper. You don't have to use as many inputs to get more quantity. So economies of scale, typically how people say this is that when you increase production, it reduces cost. And this is often the case with natural monopolies. We'll get into some of those definitions a little bit later, but this is where you have some kind of large fixed cost, some sort of unique input, and it would actually be most efficient to have only one large company producing this. In that case, the government may get involved and just say, utility companies, it's best to have one large utility company. So we're going to give the contract to one firm. We're going to heavily regulate them and limit what they can charge for prices. But it's not going to be very efficient to have 50 different electric companies because they're going to have all these poles and electric wires everywhere. It's going to be redundant. We're not going to be needing all of that capital, and it's really just going to cost a lot more to deliver electricity. Okay, if I can get this working, we will watch this. I'll put the link on the Canvas page as well. So if you don't watch The Office, I highly recommend it. Best show ever. It works really well for all sorts of stuff with economics. But in this clip, so Michael Scott is in the middle, and he used to work for a paper company. He decided to quit and start his own paper company. And he's here with his employees talking to an accountant about if they can afford to expand and hire a delivery person.
Build a website you love
And we
with Wix.
watching that. So it didn't help. And they were expecting constant returns to scale. The idea Ryan was saying, if we just get enough volume, we sell enough paper, we can make enough money because we're making $1 per box or whatever it is. And so if we just sell enough boxes, we can do that. And what he's saying is like, no, you're facing decreasing returns to scale because you're going to have to start paying for a delivery person and healthcare and a bigger office space and a warehouse. And all of that is going to make it more expensive. That's going to take away from that, profit you're currently making and actually have you lose money. How do I get to the next slide? Let's see. So there's actually different types of profit, and what we saw in that clip and what most businesses deal with is called accounting profit. They are looking at explicit costs only, so the amount of money that came in and the amount of money that went out, and they're looking at like what would be in your bank account. That would be our normal accounting profit. As economists, though, we actually care about economic profit, which includes the opportunity cost. And so we're trying to maximize profit, not just in our current business, but in all possible options. And so if an economist is saying that like you're maximizing profit, they mean you can't make more money doing anything else. You've picked the best possible option. So accounting revenue or accounting profit is total revenue minus the explicit costs. So the money that you actually paid for stuff, the money paid for labor, for materials, for rent. This is what we normally think of as profit. And then economics, we add something called normal profit and economic profit. So normal profit is only the implicit costs. This is not something you would ever see on your bank statement or a spreadsheet. This is the opportunity cost. Usually economists will take some kind of normal rate of return, something that you could be earning in the stock market or in, some other just general standard interest rate. And we would say that's the normal profit, what you could be earning in another market. And then economic profit is where we take the total revenue minus the explicit costs minus the implicit costs. So we're taking that accounting profit and we're subtracting the normal profit. And so anything that's left over, if we have a positive number, it means that you are making more money in this type of production than you would at your other option. And if it's 0, it means your two options are the same. So positive means you made a better choice. 0 means that both options are the same, so you really don't care which one you're doing. And then negative means you made a worse choice, you should go produce the other thing. Under competition, economic profits go to 0. So we say that markets kind of balance out. If one market has really high profit compared to another, people will exit the lower profit market and move into the higher profit market, which is going to cause profits to go down. Okay, so let's look at an example. How do we actually calculate economic profit? So let's say you are a belt supplier. Your initial capital investment is $20,000. And if you didn't invest in belts, let's say you said, I'm not going to make belts. I'm going to take this and I'm going to put it in a savings account and I'm going to earn 10% per year. Your other costs include materials of $15,000 and labor costs of $14,000. If you sell 3,000 belts at $10 each, what is your profit? So we're going to calculate a couple things. We're going to calculate accounting profit, normal profit, and economic profit. So first what we want to do is we want to get our total revenue. And total revenue is going to be the quantity times the price. So in this case, we're selling 3,000 belts at $10 each. We multiply those and we would say our total revenue is $30,000. Next, we want to look at our explicit costs. So explicit costs are materials and labor. So we're going to actually have to spend $29,000. And if we were accountants, we would stop here and we would say that our accounting profit is equal to $1,000. But we're not accountants, so we are going to also subtract the normal profit, which is going to be implicit cost or opportunity cost. And we're actually going to get that from this up here. Okay. So what we're going to say is that if we had invested our $20,000 in something else and we were earning 10% per year on that, our normal profit from that would be $2,000. We're not going to count this $20,000 as a cost because while we are investing it into the building and machinery, if we decide to exit the belt market, we can sell that and we can recover that cost later. So we're not counting that as an explicit cost. But what we are saying is that we have a normal profit of $2,000, which means our economic profit is going to be $30,000 minus $29,000 minus $2,000. We see that our economic profit is actually negative $1,000 from belts. So what that means is that we would make $1,000 more if we didn't invest in belts. And so if you compare the accounting profit, we see the accounting profit for belts is $1,000 and the accounting profit from just investing in the market is $2,000. So it would be better to invest in the market. You're going to make more money than investing in belts. And so we can see that from our economic profit of negative 1,000 for belts. That means don't do belts. You should go do the other thing. Okay, so total revenue, explicit costs, implicit costs, and economic profit. All right, so we're going to stop here. There's some other topic pages that go into detail about some other stuff. Definitely check those out. And we're going to continue some of this next week when we also get into perfect competition.